We have currently 3 billion euros assets under management, and actually it's been growing organically. I actually saw a statistic according to which each investor dollar is being pursued by $3 in GP funding demand. So there's an over demand to supply of 3 times. We shouldn't look at climate as a separate vertical that's somehow special compared to others. I think there's a number of early stage VC funds, which is good. But some of these companies are maturing into growth phases and they need growth funding. Vintages 2009 to 2015, the performance has been very good. So the IRR in this group of VCs in Finland has been around 18.5% with a TVPI of 2.71x.
Peter, welcome to the show. Thank you, The Drop, for having us in a beautiful podcast studio at the event venue, which is amazing. Peter, I'm very excited to have you. I think it's great to have more LPs to be on microphones and talk about what they think about in the ecosystem. And there are a few topics that I would like to address today. The European climate VC ecosystem is something I want to address to get your perspective. There are a few things that we will touch on today in terms of the mix between software and hardware. Do we have too much of one, not enough of the other? Maybe talking about growth funds, first of a kind, lots of things there. I would also love to talk a bit about Tesi in itself. What's your point of view on the ecosystem? How are you different from others? And then maybe to talk a little bit about the future of climate VC. Is that a good agenda for you?
Sounds good. Thanks for the invitation, Hugo. I'm delighted to be here.
This episode is brought to you by Accelerating Impact, a non-profit that drives impact finance by running free accelerator program to support emerging impact managers. By joining them, you will get coaching, training, financial support, and access to a strong community of emerging managers. Sign up at the link in the description, and thank you to Accelerating Impact for supporting this episode. Well, look, maybe to get started, we had The Drop. I was talking to quite a few VCs yesterday. It feels like a lot of VCs are struggling to raise money. What's happening in the European ecosystem in climate VC?
So overall, I think what we're seeing in the ecosystem currently is that there's less allocations, at least private allocations, going towards climate-related projects. And there's real tough headwinds from GP fundraising. And I recollect from last week that I actually saw a statistic according to which each investor dollar is being pursued by $3 in GP funding demand. So there's an over demand to supply of 3 times. And if you look at the statistics going backwards, it used to be much less. So I think there are issues and basically comes down to, as we know, a bit on the exit market. So exits have been really difficult. GPs are standing or sitting on a lot of NAV. Allocations or distributions are at very low levels. So the LPs are not getting any liquidity back from their fund investments. So that's one issue, and it leads to a vicious circle in the fundraising. And if we look at climate, I think I've been looking at climate for about 5 years now. And what I'm seeing is that a few years back, there were lots of new GPs raising climate related funds. And now quite a number of them have actually given up. So they haven't been able to raise or reach a target close. And number 2 is that even some of the more successful GPs are having real difficulties in closing. So delayed fundraising taking longer than expected. And a third that's relevant in climate, obviously, is what we're seeing is sort of a rebranding or relabeling of climate-related funds. So now the narrative is more towards resilience, dual use, defense, and then obviously we always also see artificial intelligence in all the pitch decks. So there's a bit of a change in the narrative, and obviously there's also a change in the operating environment.
How does that affect your investments in terms of, you obviously have to manage a portfolio, right? So is climate still a big part of your portfolio today? Will you be looking at investing in more, I guess, specialists when we think about resilience or like dual use or funds like that? Like, is there something there where you think climate is not as hot, no pun intended, but not as hot as before?
Well, I think the climate is getting hotter, so we still have lots of issues to solve. But I think that overall, probably we shouldn't look at climate as a separate vertical that's somehow special compared to others. I think we should consider climate relative to, let's say, deep tech, life sciences and health, or defense, dual use, and so on and forth. So it has to stand on its own legs. So I think there's still lots of potential in climate. Well, first of all, if we look at climate generally in Europe, I think one of the strengths of Europe is that there's lots of founders and there's lots of research going on. So they're churning out lots of these innovations. But the issue is that how to scale them. So I think there's a number of early stage VC funds doing like smaller pre-seed seed tickets, which is good. But some of these companies are maturing into growth phases, and they need growth funding. So that's one bottleneck there that I find currently that's needed more. But yes, the climate is still relevant, but I don't think we should, let's say, wave the climate flag. We should look at it at par with other verticals.
So do you think early stage is overcapitalized in Europe from a climate VC perspective?
I think that generally in climate and overall in Europe, when we talk about VC, there's lots of VC early stage funds. So funds providing pre-seed, seed funding. And also when it comes to climate, I think there's an abundance of, let's say, software as a service to climate something. So I think there's a bit of overfunding there. Obviously, we still need these types of funding instruments to kickstart these innovations. So I think that's a bit overfunded. And where the underfunding then is, I think it's, as mentioned, in the scaling climate. So lots of these companies are maturing now into their growth phases, and they need larger tickets, larger funding rounds, and there's a lack of growth funds, especially, let's say, in Finland and the Nordic context and Europe overall, because we need to be able to scale these companies to achieve impact and also to go to market. So that's where we're missing out a bit, I think, especially in the hardware heavy, let's say, first of a kind, which we'll probably talk more about a bit later.
For sure. Do you think we have enough LP capital to support growth fund? I mean, it feels like it's already hard enough to raise 100 million, 200 million fund in Europe right now. I guess if you want to do a proper growth fund, you have to go above the 300 million mark at least. Do you think we have enough LP capital for that?
I think generally there's lots of capital out there, especially if you consider private capital as well. It's more about how it's being allocated. And obviously, as from Tesi, we're a public investor, so the Finnish Sovereign Wealth Fund, one of our main mandates is to try to crowd in or catalyze private funding into these vehicles. Because I think that, at least from a public investor perspective, we're not running out of funds. It's just that we need to allocate it wisely. Remember also that commercial turns come as a priority and impact after that. So on the private side, it's more about the narrative currently. And as I said, climate is in headwinds. But I think there's sufficient amounts of capital. And obviously, we also need the GPs to set up those funds. So we need the skills and the right mindset for the GPs to do that.
When we think about GPs, what makes a great climate GP? You know, what stands out to you? I mean, and maybe for context, for people that don't know you, but you have quite an interesting career. You worked in banking, you worked in an NGO as a CFO, then you worked in a startup as a COO. So, you know, you have experience on the ground. Do you think that also affects a little bit your perspective on how you assess a GP?
I think it does, hopefully in a positive way. I can touch upon that, but maybe first on what makes a good climate GP, as you mentioned initially. I don't think the GPs in climate are different from any other verticals. So you're looking at GPs or teams that are able to source the best tech founders and find the right teams, and you're outsourcing that job from yourself to the GP team. So what we look at in a GP then is, I don't think, different from the other standard investors. So we look obviously at the GP team, because that's the most important part of it. And you look for let's say three qualities in the partners. So you need track record, so private equity VC track record, full cycle from sourcing to investing and structuring, creating value and exiting. And we need to see numbers on that. So DPI. So that's important. And then when it comes to climate, I think specifically operational value add. So you want to have someone in a GP team, preferably maybe a founder, a tech founder, who's done this before. They've actually experienced the difficulties in fundraising and how to add value, and also they get the networks on that. So someone with operational expertise, even engineering expertise when it comes to climate, because you need to understand the technology. And then finally, strategic go-to-market expertise or marketing expertise. So you need a combination of these skills. And then obviously you need to align that team with the LPs. So you want the team to put in some skin in the game, GP commitment, and rather putting in a considerable amount of their own money as well to align with the LPs. And then you're looking at the ability to execute on that strategy. So adding value, passionate, and so on. So I think that's what we're looking in the GP.
And I think if we get a bit more technical, so you mentioned track record and DPI. I'd love to learn a little more about what you're expecting there to see before investing. And on the second aspect of the technicality, the GP commit, how much should that be? What's a reasonable amount for you? I think that helps also, like if some GPs are listening to this podcast, they're probably like maybe some first-time funds managers as well. So, just trying to understand the dynamic there.
Sure, good questions. And obviously, the dynamic is a bit different when you're talking about first-time or emerging managers who are just setting up their first fund or going through their second or third vintage. And then you have more successful or fund managers in vintages 5 and 6. We as Tesi, obviously, we also want to focus on supporting the first-time fund managers because we believe it's important to bring in new managers and diversify the market. So if you're a first-time fund manager, hopefully you have someone on your team who's actually done investing before. So you're looking at, let's say they've done 20 deals in VC, the fact that they've done that, and then hopefully also there's a positive multiple to it. So it's over 1 for their whole portfolio that they've done, because that shows that they've done it, but they've done it in a successful way. So, and I think you really need that in a first-time fund, that you need someone who's done deals and they have a track record to show. And the skin in the game, I think it's standard that 2% of the fund size is GP commitment. I mean, it can be a bit lower, especially on the first-time funds. And then you need to fund that, preferably somehow from your own pocket. It doesn't mean that you have to mortgage your whole house, because you don't want the GP team to be too risk averse. You want them to take risk and you want them to be aligned with the investors, but you don't want them to be too scared that, hey, I'm going to blow this whole fund up if I do this deal and I'm going to lose my house. So it's a balance.
And talking a little bit about performance, obviously, you are in a unique position where, I mean, I couldn't count on your website how many funds Tesi has invested in by now. What is your expectation from a climate VC in Europe? Say we are talking about an early stage fund. How much returns do you expect from them?
Good question. Here I'll refer you, and I'll add a few points to our annual survey that we do. We do an annual survey of Finnish GPs on their investment returns. So you can find it on Tesi's website. But overall, just a few highlights from that. So what we've been seeing in our VC portfolio is that in the mature vintages, so vintages 2009 to 2015, the performance has been very good or fairly good. So the IRR in this group of VCs in Finland has been around 18.5%. With a TVPI of 2.71x. So that actually outperforms the public equities market in these later vintages. And what we're seeing in the newer vintages, 2016 to today, is that it's a bit weaker, the performance, which is sort of to be expected because these are fairly new funds, so they haven't been really able to show a track. And obviously, as we discussed earlier, the exit market is really tough currently. So difficult to exit, difficult to show that DPI, but we think that there's lots of potential in them. And when it comes to climate-specific funds, It's early days. I think this whole climate GP investing thing was invented 5-6 years ago, or that's when most of the GP climate funds came out. So it's a bit early days. We don't have any like hard statistics because they're still in investment phase. And as an example, let's take PayBlue, who's organizing this event. So we're invested in both of their funds, 2020 and 2024 vintages, and they're doing great stuff. And there's lots of potential in the portfolio, but we can't really show the numbers yet because it's early stage and they're still investing. But on a side note, what we like about our climate funds as well, that they help build the ecosystem. And as we're seeing here in this great drop conference here, is that they're putting lots of effort not only in investing, but also building the ecosystem. I think that's important.
Yeah, for sure. Well, look, maybe to transition to a little bit of another section. You mentioned earlier in this episode that we have a few gaps right now in the climate VC space. One of them being first of a kind and being kind of the, I guess, growth stage as well fund, because that's when usually they come in. You've been involved in the past through your experiences in first of a kind financing. My first question to you would be, is first of a kind really a VC case? Is that really where we should put VC money, or is that for someone else?
I think we need to define a first of a kind, but let me first answer that question. I think it's first of a kind when you're investing in asset-heavy scale-ups where the funding requirements, it's usually setting up a demo plant is, let's say, from 30 million to 300 million. It's not a traditional VC game. Because in VC, you're looking at more early stage, small companies and startups. And when it comes to first of a kind types of investments, at some point, these companies, they have been early stage in their laboratory and pilot. We call it the technical readiness level of, let's say, 3 to 5 early stage. That's where the VC play is in first of a kind. And then later on, it's more for growth funds. And obviously, there is potential if you are as an investor in early stage to actually profit from that scale up if the first of a kind project succeeds.
And why do you think that we are missing growth funds and maybe appetite to invest in this type of projects? Is it too risky for the model that we have today? Are GPs not skilled in Europe to do that? Or are LPs not willing to invest in this type of funds? Like, what's the story there?
I think it's not the laziness of GPs. It's more about the fund structures and that these first of a kind are a bit novel type of structures. So first of a kind, you're talking about proving a new technology or solution that it could be proven that it can scale commercially. And let me just take an example. It's easier to explain. So quite often we talk about this technical readiness level, TRL. So when you have something in the lab and pilot and early stages, it's a low level. And it goes from about 4 to 9. And at 9, we're talking about a commercially viable, scalable product or technology, like a coffee machine. That's scalable. And I'll give an example. There's a company called Solar Foods, which is also in our portfolio. It was a Finnish startup set up in 2017, a spin-off from university. And they came up with a technology where they combine water, carbon dioxide, hydrogen using electricity to create a powder, a protein powder that can be used in food stuff. So it replaces, let's say, wheat in pasta and so on. And that's where the impact comes from. But also that it should be a great product and cost advantage and so forth. So when they started in the lab at university, they were in the lab with a test tube creating maybe a few grams of this powder, which they call Solane. So this white protein powder. And after that, they needed to increase the volumes. So they went to what we call pilot phase, TRL 4 to 6, and they were maybe producing, let's say, hundreds of grams. So they had shown that this technology actually works, and they had gotten interest at that pilot phase already from commercial buyers, because in the end, that's what you need. You need offtake and commercial interest, industrial buyers. As an example, and this is all public because they're listed, by the way, nowadays, so you can check out the information. NASA was very interested in this at the pilot phase because you could use this in space exploration as a food supplement for astronauts. At least that got my interest. Sounds really cool. But now we're in the conundrum. So before they can actually sell this to an industrial buyer, they need to prove that it actually scales. So you need to go from a few hundred grams or kilos to actually tons or tens of tons of this final product. So to do that, you need to set up what you call a demo plant or a first of a kind plant. And this is where the issue's gone, and this is where I'll also answer your question of why it's difficult and sheepies see it as being difficult. Because at this point, you need to set up a real physical plant, which is large. So first of all, it needs a high amount of capex funding. So usually, if setting up a plant, it could be 30 million, it could be $100 million. So that's one barrier. And then secondly, you're still running a technological risk. So you're still at this level of 6 to 7, and you need to be at 9. So when you think of a new innovation or a process like producing this solar powder, you suddenly have to build a huge factory. So you have to engineer it. And depending on what sort of equipment you put in the factory, is it off the shelf? Do you have to invent a totally new reactor? What's the energy balances of this factory, and so on and forth? It's really interesting, but it's really complicated as well. And you don't know if it's successful before you ramp up the plant, run it, and you get out a product, and then you test it. So is the quality the same as in pilot and lab? Will anybody be interested in buying this? Which brings me to the third sort of obstacle, which is the off-taker risk. Because as a funder or as a GP, you need to be sure that you're potentially getting your money back. So what you're looking at is having as much off-take agreements, binding agreements before you do your investment decision. But as with the Solar Foods case, NASA, okay, they're interested, but no one's going to commit before they know that you're actually getting out the volume and the quality. So that's one issue is off-take. And then finally, I think there's a funding gap as well, because, well, that's what we're talking about here, is that who else is going to fund this pilot plant? It's not just equity. You need to bring in a blend of grant funding as well, and debt and mezzanine and so on and forth. So with all these obstacles, I think that's one of the issues, that you need the right type of fund structure. You need to bring in other types of financiers, but obviously you also need, let's say as a GP team, you really need the engineering knowledge. So you need to have someone who's actually ran a plant before, ramped up a plant. There's always issues when you ramp up a plant, and then ability to solve those issues and add a value. So I'm talking about lots of challenges, but obviously there's also an upside. So once you are successful and you're showing that you can scale up and produce large volumes at TRL 9, then you have a huge platform play.
Let's unpack a few things in first of a kind. The first question I have for you is, should we really finance a first of a kind through equity? Equity is a form of capital that's very expensive. Is it suited actually to invest in a factory? Should it not be a debt instrument or something a bit more similar? What's your point of view on that?
Excellent question. So if it's pure traditional VC, you probably shouldn't be investing when it goes to the demo plant phase. You should have invested when it was in the lab and a pilot, but you probably still have a stake, so you're interested, or you might want to exit at that point. But overall, when you look at this first-of-a-kind demo plant funding, you hit the spot. So it's not just equity. You can look at it as a platform play, as you have a developer who needs funding and DevEx. So you could invest equity, I think, belongs there on the developer side. So then your profit or you're receiving potential profit from the SPVs that the developer is going to set up, the SPVs being the plants. And then on the SPV side, because it's CapEx heavy, there you need a blend of different instruments. So obviously a little bit of equity, but then you can look at mezzanine structures, senior debt, grant funding. Quite often in some of these demo plants, there's actually grant funding available. You shouldn't rely on that, but that's one component to it. So it almost goes into infrastructure investing, where there's always a blend of different instruments going in.
And how do we de-risk a first of a kind? What are the, I would call them reassuring factors, or what are the elements that a VCs or growth firms to that extent should be looking for before investing in companies that's going to set up a first of a kind? Because you mentioned earlier, for example, you would want to see a commitment from customers, right? But maybe we want to also have a CVC from a potential customers investing, or what are the things that we should be looking for in terms of de-risking that approach to first of a kind?
Well, first I would go back to the very basic of any investment. So asking the right questions. So first of all, what problem are we solving with this new technology? For example, in food tech, we're solving a protein problem. Is there traction? What type of traction is it? So as I mentioned, for example, in the pilot and lab phases, they had pretty good interest in this product or any other. So you need the traction, and then you need to look at the people. So the founder team, the people in the organization. Usually, when you go to the demo side or first of kind, you've already built a sizable organization. So you need to know how that works and are they really passionate in solving this problem. But then de-risking the demo plant, then I think it's a combination of trying to understand the technology. You need a good technical due diligence and a good engineer and the science behind it, depending on what sort of project it is. And as an LP, obviously, you also hope that you understand the technicalities. So having an engineer, for example, as an investor would be great, because you're trying to understand, is this going to work at scale, this plant, what can go wrong? And then the offtake, I mean, that would be the greatest or easiest, well, not the easiest, but one of the most important ways to de-risk is having commitments from off-takers that, okay, if everything works out, we'll purchase 50% of your product in the next 3 years, or 70 or 80.
I guess to transition to another topic, you said earlier that you are a catalyst for the ecosystem. You're trying to help emerging managers. How do you define yourself versus more typical LPs, if there is even a definition of typical LPs, right? But how do you define Tesi specifically? What's the mission that you have?
So starting from the basics, Tesi, we're a government-owned investment company. You could call us a sovereign wealth fund. We've been active in the markets for 30 years. And what we do is we do direct VC and growth investing. We have a separate team for that. And then we do fund investing, and I'm on the fund investment team. So overall, we're a very active investor on a European scale in funds. So we're invested in about 125 funds and with 60 GP relationships, most of them being in with Finnish GPs. So you ask about what makes us unique, is that, or most of the sovereign wealth funds, is that they're usually tied to government interest. So here we're tied to a Finnish interest. So the reason that we exist is that we're supposed to, or we do support the growth of the Finnish ecosystem, the VC and PE ecosystem, while at the same time our mandate is to return market level profit. That's our dual mandate that we have. So we're tied loosely to a Finnish interest. So our direct investments are mainly in Finland. And on the fund side, most of our investments are with Finnish GPs, because we want to support the growth of Finnish GPs and the private equity and VC and growth ecosystem through those funds.
Is there enough GPs to actually only be investing in Finnish GPs, I mean?
Yes, it's not enough. So that's why we're also invested in what we call, let's say, international GPs. So GPs also investing outside of Finland. And that's, I think, the great flexibility that we have. So obviously, for example, Pale Blue Dot, we're here. They invest in the Nordics, potentially even in Finland, and a few other climate-related funds that we invested in that also invest outside of Finland. And when we look at those funds, we're not maybe as strict as some of the sovereign wealth funds are that might require, let's say, 1x of their ticket to be invested back in their home country. We don't want to do that, because we think that it misaligns the LPs between each other. If one LP says that you have to invest in my home country, and the other says that that's not good for us, and that might also skew the GP natural strategy. So we just need that the fund can or could credibly invest in Finland. So we look at their strategy, and if their strategy is credible and they cover Finland, then that's quite often good enough for us. So that's why we also have some of these international GPs in our portfolio.
And how do you think about geographic concentration of your investment? Obviously, I understand that there's a Finnish interest behind the sovereign fund, but equally, for any country in Europe, anyway, Finland is quite small, but I guess France as well to some extent. Do you think that it's not too risky to only or try to put all your eggs into one basket, which is Finland in that case, and to also expect to have above market returns?
Obviously, if we start from the really high level, if let's say if we didn't have a Finnish interest, then we could just give all our capital to, let's say, BlackRock or another asset manager and say that, hey, just disperse this and make a profit. And we have currently about 3 billion euros assets under management on our balance sheet, so it's a considerable number. And actually, it's been growing organically. So I think that's already a good demonstration that you can actually invest domestically if you invest in the right companies and still make a profit. Obviously, you need to diversify your portfolio as well. And I think that lots of the underlying portfolio companies can be broadly already commercialized within Europe or internationally. So even though the target company, let's say, is Finnish bred or based in Finland, then you're actually diversifying through the market and the growth in these companies. So let's take Oura, for example, the health ring, a Finnish company, and they're basically global today. Their customers are not just only in Finland, and there's lots of these examples. So it's not concentrated in Finland if you look at all the asset base or the portfolio companies and where they operate their business in.
For sure. Well, I guess one last section for you today. What's your vision for the future of climate capital? Are there some emerging trends that you would like to finance as an LP?
Well, overall, when we're talking about climate, interesting subject. So as we know currently, climate, the narrative has strong headwinds. And I think that's natural in a way, because what we're experiencing now in our operating environment is uncertainty. So first COVID, then the war in Ukraine. So if you just, let's say, quote Maslow's hierarchy of needs, the needs of human beings is for food, shelter, and water. And if we don't have those, we can't really improve on other fronts. So let's say building a career or investing into climates and so on forth. So I think it's natural that currently some of the climate is being relabeled into resilience, dual use, defense, because that's the topic and that's one of the worries that people have as happening in our operating environment. So that being said, I think that in climate, looking forward at climate, as mentioned, there's still lots of issues that need to be solved. But I think we can't just wave the climate flag as strongly, but we need to go back to the fundamentals of investing. Which is when you're looking at climate, you have to invest in solutions or technologies that reduce the fossil resources and depletable resources. So quitting burning and so on forth. And you look at new technologies that actually add a cost or are superior with a cost advantage. So going back to the market basic. So we want to see climate investments that have a market pull. We don't want to push climate into the market. And I think that's one of the issues that we've been experiencing lately, in addition to the narrative changing, is the fact that, for example, a green premium that was expected to be paid by industrial off-takers or by consumers just because it's climate, I don't think that exists anymore. And because there's no green premium that the market is willing to pay, we have to look at superior products at a cost advantage that have a pull in the market. And I think that profit will follow. And with the profits, I think will follow also impact. And as I mentioned previously, I think there's lots of interesting innovations in Europe. The scientific research basis is there and it's strong, and there's lots of tech founders. It's just that we need to scale these solutions to market. And as I mentioned, you can call it whatever you want. You can call it resilience or dual use or defense. Actually, when you're talking about resilience, there are lots of these solutions in what we call climate that are actually part of resilience. So let's say energy storage. If you can develop energy storage, you're actually building your resilience as a society. Grid efficiency, fantastic. That also reduces your electricity losses, and that's considered as resilience. Or then let's say satellites that are monitoring forest fires, that has a climate impact, but it's also a defense implication to it. So, and circularity as well. I mean, all these innovations in circularity, you can call them resilience as well, because you're improving your resilience to outward unexpected events by being resilient as a society and an economy. So I think maybe climate needs a bit of relabeling, or just focusing on the solutions and scaling them, instead of just talking about CO2 emissions, which is important, but I think it will follow with the profits.
No, that's very interesting. Well, look, we are at the end of this podcast. Maybe one of the questions I would like to ask you is there one advice that you would give to a general partner trying to raise a fund right now in a tough fundraising environment?
Well, you're setting up a team. So choose your partners wisely. And as mentioned, you need those three things. You need the track record, you need operational experience, you need go-to-market strategic understanding. But most of all, you need to be passionate. You need to be high conviction, and you need to find the right founders to do that with. So that's what I would say, and you also need to be able to support. In the end, what you're doing is you're building value through your portfolio companies. So showing that you're so passionate that you want to succeed together with these tech founders is important. And then remember that you're in this game for at least 10 years. If you're successful, maybe the rest of your life. So choose your partners wisely and your team.
For sure. Very, very interesting. Well, look, we are at the end of this episode. I think, so I'd love to ask you, if people want to reach out to you after this episode, what's the easiest way to find you online?
Well, I'm on LinkedIn. I guess that's the platform where we're all on. So that's probably the easiest way.
And to connect with Tesi, I believe there's probably like a form on the website.
Yes. So we have great website. We have the whole team there with all their contact information. That's also one channel if you do want to connect. And happy to answer any questions or connect on any front or in any of these events.
Love that. And then one last question for you today is, who's the next climate LP or like LPs that invest in climate funds that should come on this podcast?
I wish I had an answer for you. There's plenty here. Now that we're at the conference, I'll keep that in mind. And I'll give you a shout if I find one.
For sure. Yeah. The idea, we were talking about this before this episode, is if I find someone at the conference, let's just bring them in the room and ask for an interview. But well, thank you so much for today. I learned a lot from you. I think it's interesting to have your perspective on the ecosystem as how it's going to evolve towards different label and different maybe strategies for VC firms. Also love your approach on and your perspective on what's missing in the ecosystem today when we talk about growth funds and first of a kind factory. I loved your also analysis on what makes a great partnership in a fund, so what you need to be successful there. So very, very interesting. Thank you so much for taking the time today. I'll always say it, but like listeners, if you like this episode and if you like the show, please don't forget to like, comment, and subscribe if you're on YouTube, or to give us a 5-star review and a follow on Apple Podcasts and Spotify. This really helps the show and allow us to get amazing guests like today. So thank you so much for coming on the show. I appreciate it.
Thank you. I really enjoyed the conversation.